Hi and welcome to Swissquote's Daily Market Talk. It's Monday, April 14th. There is a gentle breeze of optimism across the global financial markets this morning on news that the technology could be exempt from the massive Chinese tariffs from the US, but the headlines remain hectic and unpredictable, of course. Big jumps in stock valuations could be followed by big slumps, and the thinning holiday volumes into the Easter holiday could make trading choppier than otherwise. So the new week starts on a positive note, yes, against all odds. And after a disastrous week of tariff roller coaster, the new week starts on relief that the United States will exempt electronics, most of which are made in China, from the headline tariffs. So the idea of Americans sitting on a production line and building smartphones there to sell them for prices above $3,000 per phone, for example, didn't really seduce Donald Trump and his team. Apparently, Apple jumped 4% on Friday, and that was even before the news. The S&P 500 gained some 1.90%. The first sight of bank earnings from the US was encouraging as well. The JP Morgan, Morgan Stanley, and Wells Fargo, they all announced earnings that exceeded analyst estimates in the first quarter of this year, but their CEOs actually sounded very much concerned about the tariff uncertainty, with JP Morgan's Jamie Dimon warning of considerable turbulence due to tariffs, inflation, and high deficits, suggesting a recession is increasingly likely for the US economy. So the stock still jumped 4%, as I said, on Friday's trading session, but Wells Fargo, for example, slid after announcing its own earnings. Now, this morning, we are before the European Open at the time I'm shooting this video. The futures are hinting at strong gains across the US and European indices. Hon Hai, on the other hand, a major Apple supplier, jumped open in Asia this Monday morning, but is giving back gains since then, as the US President Donald Trump said Sunday after his golf that the technology sector won't be exempt from tariffs, that they will be in a different tariff bucket instead. So we will probably see another week of hectic and unpredictable headlines, uncertainty, and perhaps high volatility. And the thinning holiday volumes into the Easter holiday won't help in terms of volatility. Now, for those who missed the latest tariff news, last week the US still increased its tariffs on China to 145%, despite giving a 90-day pause to other countries, and China increased its own tariffs on US imports to 125%. In the meantime, the Chinese exports jumped more than 12% in March as companies front-loaded stocks before the tariffs came into effect, apparently, while the Chinese imports fell more than expected during the same month, leading to a ballooning of the Chinese trade surplus, the kind of news that Donald Trump hates. But the CSI 300 index gave a limited positive reaction to the data this morning, though the Hang Seng index extended its gains by 2% to above the 100-day moving average. Now, there's also some optimism in China regarding the Chinese stimulus measures to help the Chinese economy weather the trade shock during the coming months and perhaps years, and the rest of the world, on the other hand, benefits from a 90-day pause to tariffs, as I said earlier, but is still imposed at 10% on their exports toward the United States, and now has got less than 90 days to seal a deal with Trump administration. As such, the tariff pause optimism should be taken with a pinch of salt. The trade negotiations with the United States are creating tensions and leading to divided political opinions in many places across the world. In Switzerland, for example, the decision to invest as much as 150 billion US dollars in the pharmaceutical sector of the United States on the US territory didn't echo well across the political spectrum. Each job created in the United States is one less job created in Switzerland, responded many politicians out there, warning that the tariff chaos will soon turn into a global political chaos before the manufacturing and, more importantly, well qualified jobs are moved toward the United States. So, despite Friday's relief rebound across the US equity markets, well, the sell-off that we saw across the US treasuries accelerated in the sense the US 10-year yield hit the 4.60% mark on Friday's trading session. Many doubt if China has a role in last week's rapid sell-off in US treasuries, as the Chinese are one of the biggest holders of the US government debt, and they could be selling their US treasury holdings as part of retaliation to tariffs. But Japan, on the other hand, which is another major holder of the US debt, said earlier this Monday, that they wouldn't dump their US Treasury holdings so fast. So in all cases, a Federal Reserve official finally blinked last Friday, saying that the Federal Reserve could eventually intervene if necessary to calm down the markets knows as no one in the US or outside the US wants a flash sell-off across US treasuries that would inject a bigger chaos across the global financial markets, because the US treasury yields and the US treasury holdings are the basis of the financial system and of the risk sentiment. So the 10-year yield is a bit more stable this morning, just below the 4.5% mark. Gold extends gains above the $30 to $20 level on rising bets that the US treasuries are losing their safe haven status thanks to the US hectic and harmful trade policies. The US dollar, on the other hand, remains under a decent selling pressure this morning again. The euro, the Japanese yen, and the Swiss franc amass a lot of flows these days. The euro dollar approached the 115 psychological mark last Friday, mind you, and the euro will likely remain in demand against the US dollar despite a broadly expected interest rate cut from the European Central Bank this Thursday. If nothing, the strong and the strengthening euro and lower energy prices do give the European Central Bank a nice maneuver margin to act and support the economies right now while not boosting inflation on the other hand. The Japanese yen, on the other hand, extends gains against a broadly smashed US dollar as well. The dollar yen tested the 142 level last week to the downside, and it's just a matter of time before the pair tests the 140 psychological level in the coming days and weeks, while the dollar franc shortly slipped below the 81 cents level on Friday under the horrified eyes of the Swiss National Bank that doesn't want to see the franc strengthen so much when the Swiss companies are already subject to a 10% rise in their products in the US market due to the universal tariff. So the consensus among bank analysts right now is that the Swiss National Bank wouldn't necessarily go negative on the interest rates this year, but the strong and the stronger Swiss franc tilts the balance in favor of that option, in my opinion, as the rising uncertainties on the trade front will unlikely let the franc take a breather anytime soon. And the stronger the franc, well, the higher the price of Swiss products will be in the United States on top of the tariffs. So this week, besides the European Central Bank meeting, investors will watch other US big bank earnings, European, British, and Canadian inflation figures, the Bank of Canada decision that's expected to remain seated on its hands, by the way, TSM and Netflix earnings as well, then the US retail sales and business inventories. And all that amid the trade uncertainties are like flying in the air. So in the sense, the earnings will matter, but the forecast will probably matter more due to the trade uncertainties. Then the US consumers, for example, may have stepped up their purchases before the tariffs hit. Therefore, we could see a big jump in US retail sales this week, but that won't necessarily mean that optimism among US consumers is on the right track. On the contrary, the US consumer sentiment is souring under the pressure of massive tariffs, according to the University of Michigan's latest sentiment index that actually eased to the lowest level since the pandemic months. And of course, the impact of the tariffs hasn't even materialized just yet. So we could actually see all these data get worse before anything gets better. So brace for volatility and hold tight. This is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.